All right, what's going on, everybody? It's another week, which means it's another wealth webinar, and thank you all for joining us. And this is part number 5 of a 5-part series talking about the infinite banking concept and privatized banking and how that can work for you to take back control of your money, how you can move your money, and how you can do what the wealthy do with money. And there's a lot of money talk right there, but you know what? As Mark Twain said, money is definitely something we need to all get pretty good at. Really go over today is we're going to talk about cash value lines of credit. We're going to talk about how you can use the bank, even though we're trying to get rid of the bank. We're going to talk about how we can leverage the bank to make more money. And that money that we're going to make is in the spread. So we're going to show you how we're using that. And we're also going to show you what is the mapping process. What is the mapping team doing and how can they help you? Because, you know, it's all great to learn what the infinite banking concept is. It's great to learn how to use this system, but the mapping team actually is what I call where the rubber meets the road. It's where you actually see this machine, this specially designed and engineered whole life, actually being put to action using the infinite banking concept. And Brent's going to do a great job of showing you an example of the mapping. And then we can really hit on just a few. We get a lot of questions. And we got a lot of people, pretty much the questions are all the same on the calls we do. And we're really going to dive into a few of those. And Steven's going to talk about some of his experiences when he gets calls and the different questions they're asking. But what I'm going to do real quick to dive right into this thing is I'm going to share my screen here. And we're going to jump right over to this. Get this thing up. Minimize. And Steven, you're watching the comments there because I got to get rid of them. Yeah. So there's when we get into this, there's 2 different ways that we can use the money inside of our specially designed and engineered whole life. Now, if any of you are brand new today, you missed 4 parts of this entire series where we explained what the privatized banking policies are, which are specially designed and engineered whole lives. We talked about how the infinite banking concept works and how it's a process, not a product. We talked about lots of application and different ways you can use this system for different things in your life, from buying cars to financing the copy machine in your office, all the way down to paying off debt and other things like that. But one thing that we really want to get into now is how do we take this and actually make more money without having to work any harder, any longer, and without having to take on any risk by simply tapping into leveraging a bank and leveraging lower interest rate environments like we're in today. Now, I'm not going to say that what you're going to see here is the end all be all, but we're just going to get to the mathematics and show you how these numbers actually play out when we leverage the bank's interest rates versus using the insurance company, you know, and using them to take loans. Now, I've always taken loans from the insurance companies. That's how I've always done it. And my loan interest rate's always been a variable 5%. But because my policies are always making more, I'm always winning. It's because I'm making the spread of what I'm making and what my cost of capital is. I make the spread. That's what this is all about. And the best part about this concept is that each year you get a raise. Brent did a nice example showing a business and how every year that business made more money. Well, that's what this is. Every single year, without you doing anything more, because of uninterrupted compound interest, you get a raise. What a grandiose idea, right? Imagine showing up to work every day, doing nothing else, literally just kicking your feet up, sitting there. And then every year your boss comes over and says, you're going to get a raise today. Such a great job. But you did nothing at all. Well, that's what this does for you. And that's just because of mathematics, because of compound interest. But we can improve that mathematics because we can reduce the cost of the capital by using a bank. And this is not always going to work for you, okay? This is going to work right now, primarily because we are in an incredibly low interest rate cycle. So what you're going to see and what I'm going to show you really is utilizing a bank. And not all banks do this, but most will, because remember, Brent and I and Steven always tell you that the #1 purchaser of whole life insurance in the world is none other than traditional banks. However, you can't walk into your bank with all your money that you want to save and say to the bank, hey, listen, I want to put my money where the bank puts their money. We already know the bank puts their money in whole life insurance. You can Google it. It's called BOLI, B-O-L-I, bank-owned life insurance. So if the banks are putting their money there, we need to understand why. But the second thing we need to understand is that if banks are putting their money, their tier 1 capital in cash value, okay, whole life policies, then do you think banks would like to lend against the cash value in your policy? Yeah. So folks, when we look at this, I want you to really envision your house. Most of you have equity in your houses. And if you want to tap into that equity, you go to the bank and the bank gives you a home equity line of credit. And basically the bank will give you usually 80% of the equity in your house. But imagine if the bank would give you 100% of the equity in your house. Wouldn't that be better than 80%? Sure would, but they will not do that because there's risk in them lending on the equity in your house. But see, with a whole life insurance policy, there is no risk for the bank. So therefore, the bank will lend 100% of your available cash value. And just like a home equity line of credit, how does the bank do it? Well, the bank takes collateral by what's called a collateral assignment. They take collateral, and that collateral is none other than your cash value. So if you looked at this example, if this is your policy, and just so you all know, this example is my 7th policy that I set up. It's with one of the companies that we use, and I put 30 grand a year in. Now, I don't want any of you to get hung up on the 30 grand. That's just my number. Your number might be 5,000 a year. It might be 500,000 a year. It doesn't matter how much you put in. The number is your choice, not ours. This is just my plan. So immediately when I put that 30 grand in, I had access to the cash value, 27,000. And I had 2 ways that I could borrow that money. Number one, I could borrow that money from the insurance company, and my interest rate is 5%. Now, in today's world, because things changed with 7702, that interest rate might be lower on your new plans, but this is one of the old plans. So my borrow rate was 5%. So if I were to take the max loan, okay, which this is off a little, Andrew usually plays it really safe when he comes up with these. So he's saying it would be 25, but I actually indeed took 27 from this. But if I did that, my loan amount of 25 would be charged 5% interest. So in the first year, the cost for me borrowing money would be $1,024. Now, in the first year, if I took, that percentage of my money out, 25,000, and I had to pay interest on my own money, that's $1,000, when really my cash on cash return that year sucked. I actually lost money. And most people stop right there. They say, well, that's so stupid. That thing's a scam. Why would I ever put my money somewhere that when I want to use my own money that I saved, I have to take it out as a loan and pay interest on that? Well, that's nice short-term thinking, but you are correct if you are the type of person that only looks at 1 year of the rest of your life. If that's the only thing you care about, this is a terrible solution for you. But if you're like most of us that look into the future and say, how do I better my financial future for myself, my family, and those around me in the future? Well, then we're not really so focused on what's happening this year, although that's the start of it. And the first thing I did is I just changed where my money was going and I put it in, knowing that the first year was going to be a bad year, because the first year, as we always say, is the worst year. So it cost me $1,024 to take that money out. In that year, I was at a cash on cash return of -14. So now I gave you guys the bad news. Now let's get into some of the good news. So now we go to year 3. I put 30,000 in. And that year, I can take out 30,896. Now, what I'm noticing that Andrew may have given me the wrong numbers because this is not correct. So now I feel like an idiot because my numbers are off and I didn't double check them. But I put 30 in and I can take out 30,896. That is actually not a negative 4.22%. That's probably a positive. Hey, Andrew, is he still here? Yeah, grab him. I just want to make sure I get these numbers right because this is definitely not correct. So ignore these for right now until I get you guys the proper numbers.
He's using he's using the loan amount available, that 28,000 number, not the 30,000. That's the actual cash value.
I see what he did. He's using just the loan amount and doing the return on that. It's just because he did it with Excel and got the wrong numbers. So anyway, these numbers are all off. The first year is not -14. The third, this sucks. I'm almost going to just stop this because these numbers are just not correct. He did them on the loan amount.
No, Chris, it's good. It's good. Just keep going. It's the whole concept of it. Okay. Right. Because the thing you got on the third year, you put in 30,000 and you've got $30,800.
So you can see I made money
increase. And he's just taking the loan amount available, which is somewhere between that 28.7 number and that 30,800 number. So it's just the concept. If the numbers are off, you know, $1,000 or what, I mean, again, guys, don't let the nickel hide the dime. Don't trip over dollars to pick up pennies. Just get the concept. So keep going, Chris. You're doing good.
All right. So if it costs me 5%, but my money over here is making 6, again, ignore these numbers because these numbers are completely wrong and based on the loan amount, not the actual amount you're earning interest on. So I know with dividends this year, I'm making 6, but then it's costing me 5. And if I look at the amount of cash value increase, you can see by the third year, if I put 30 in, I'm making more than 30. So I'm in a positive cash on cash return. So in that right there, looking at those numbers, now I'm working in a positive fashion. And each year, the best part about this, each year that I have this, the number goes up. As you can see, the 5th year I put 30 in and I can take 33 out. The 10th year I put 30 in and I can take 38 out. See how it just keeps getting better? The 15th year I put 12 in and I can take 29,000 out. And every single year, what my goal is going to be, which you're going to see in a second, is going to be put money in, take that money out and use it to make more. So if I took 25,000 out the first year and I lent that money to Steven at 12%, number one, I make money once here, but also twice in the spread. Okay. So I make money on the spread and I also make money in what my money is doing when it goes to work for me, which could be lending here. And each year I do that. So each year that I make money, this year I take out 28,000. Okay. And I maybe lend that money out or I buy a car at 5%. So each year my money's working for me, but my money's working for me twice, not just once. So I'm making money here and I'm making money here. And the only thing I lose in the middle is the cost of my capital. So using it from the insurance company, the cost of my capital is 5%. So now by utilizing it again, I know you all want to focus on the math that's wrong. So I'm just going to do that because that is totally screwing me up. But now if I go to the insurance or if I take and I don't want to use the insurance company money at 5%, and what I want to use is the bank's money, the bank, the one that I actually use, Coastal States Bank, is 3.25%. If any of you want to see the full video explaining how cash value lines of credit work, you can just go to at the Chris Naugle on YouTube and you can watch the video on it. But now my borrow rate's only 3.25. So my loan interest, instead of being 1,000 in the first year, is now 832. Instead of being 3272 in the third year, is now 26. You can see my cost of capital is lower, but the amount that I keep making never changes. It just keeps going up and up and up. So this is what I'm using now, is using a cash value line of credit, because now I can borrow at 325 when my money continuously, as long as dividends stay where they're at. If they go up, great, I make more. If they go down, great, I make a little less. But I'm at 6% with this policy. So that's a good proposition. So right out of the hole, I'm making a decent spread. Instead of just making 1, now I'm making 175. I'm making more money. Actually, that would be 275. So I'm making more money than I was making before. That's what I love so much about the cash value line of credit. The second thing is, the reason I love cash value lines of credit is it gives me the ability to take, I have 8 policies now. So I have 8 of these policies. So before, if I wanted to take loans from the insurance company, I have to call each insurance company, take a loan, or I have to go online 5 or 8 different times and take a loan from each if I wanted to use all the money in my policies. Now I basically household all 8 of my policies into one checking account. And that one checking account is my line of credit through the bank. So because now I've got 8 policies all leveraged down and householded into one checkbook, that line of credit, it makes using this a lot easier. It makes tracking this a lot easier. So every dollar that goes out, like I said, you know, every year I'm taking the money out. That money's coming, whoops, sorry. This money every year, that money's coming out, that money's going out. Every year I'm making that money go to work. So every time I make that money go to work, it's making me something. Plus I'm making this spread, but the spread keeps getting bigger because every year I'm compounding on a higher amount. And then when I take that 12% that Steven decided to pay me on that loan, what I do is instead of putting it in somebody else's bank, I basically pay down my line of credit, basically making that money available to me every time I put that check into this line of credit checking account, it's paying my line of credit down, which means I have whatever that dollar amount is, let's call it $1,000. You know, if that was the amount that my money was earning, that $1,000 I put in here means I have $1,000 to use the next day. And it also means that when I pay this down, I'm paying 3.25% on a lower balance every single month that I put money back into my banking system. And all I do is I just keep moving the money in and out, in and out. Every single time there's cash value, I find a place for it to go to work. So with that, that's one of the big things that we've started using here for my banking system, because it's just simplified it and it just improves my spread. And you can see here's some of the numbers for my policy. So my loan amount available was 93% in the first year. My insurance interest rate, well, today, this is how much you could borrow, but mine was at 5%. And then the cash value line of credit is 3.25%.
Hey, Chris, can I make a couple comments?
Yeah, please.
Yeah. Again, okay. So anyway, just to go back to those numbers of your cash value increase and your loan amount available. And basically what Andrew did is he just took 93%. Right? Okay. So like if you see down there, the writing where it says loan amount available is 93% of cash value. So really of that cash value, like if you look at year one, the cash value of 27,534, if you type into your calculator 27,534 times 0.93, that's what's going to give you the 25,607. So anyway, he's just telling you that your loan amount available is not necessarily your whole cash value in the policy. And so here's the reason for that, because there are companies, not every company, but I believe most of the companies are going to charge you the loan interest in advance, right? So let's assume the loan interest is 5%. So they're going to charge you that in advance. So let's just say that you borrow out $10,000 from your policy and you keep that money out for a full 12 months at 5%. Well, the loan interest is $500. So instead of them giving you the $10,000, they're only going to give you the $9,500 because they're charging the loan interest in advance. Now, if for some reason you don't keep the whole loan out for the whole year, and for example, let's say you keep it out for 6 months, then you would have a credit of the loan interest. It would only be $250. So you would have a credit of $250 because they charge you $500 and you only kept it out for 6 months. So I think that's exactly how Andrew kind of designed this. And I'm kind of glad. Okay, Chris, I know it kind of frustrated you a little bit, but I'm glad Andrew did it like this, because what he did is he's actually under promising, right?
That's true. That's true.
So he's under promising, and in real life, the numbers look even better. All right. So all we're trying to do is get you guys to see the concept. It really doesn't matter if that was 90% or 95%. He used 93%. And I'm assuming the reason he did it is because he's taken into account the interest that they're going to charge you in advance. So you would not necessarily get the whole 27,534 in the first year. You're only going to get the 25,607. Now, you're probably going to get a number higher than the 25,607. But if we tell you that you're going to get 27,534 and you only got 25,607, then you guys are going to be mad. So we would rather under promise and over deliver. And that's what we have trained Andrew to do, is to look at it, at the worst case scenario. And then another point that needs to be brought up in this that Chris didn't even mention is this is the raw form of the policy. This is assuming that all you do is you buy this policy and you put it on the shelf and you never ever use it for the banking concept, which is not going to happen, because the thing you're going to do is you're going to pay premium into the policy. And what you're going to do is you're going to borrow out and buy the things that you're buying in life anyway, right? You're going to finance your cars, your houses, your real estate investments, your taxes, your charitable giving. All right. So it really, the thing you're doing is you're keeping the money in motion. So the numbers only get bigger when you're playing honest banker with yourself and you pay yourself back. And I know I sound like a broken record to people that have heard me say this over and over and over again. But if you go look at the book called Becoming Your Own Banker, this book right here, all right, Becoming Your Own Banker, the 5th edition by R. Nelson Nash. And if you look in that book and take a look at page 54, 59, 60, 61, and 62, you will see that the numbers get bigger with each of those pages, even though it's the exact same person, the exact same policy. He's just using the policy for more of the equipment that he has to buy anyway. So I'm kind of, okay, so anyway, I know, okay, so anyway, I guess I know that this frustrated Chris a bit with the numbers, but I like the numbers like this. I personally like the numbers. I like seeing them lower than what they're actually going to be just in real life. And you got to remember, everybody's going to use their policy differently. So everything's going to change. But basically what we're showing you on this raw version of the form is basically the worst case scenario of what would happen if you bought the policy and you let it sit still. Now, I know we're using non-guaranteed values, and there is another column on the illustration called guaranteed values. So if you really want to peel back the onion, for those of you that are very analytical, then maybe you should look at the guaranteed value of the column instead. And that guaranteed value will even be a little less. Or maybe what Andrew did is he took the guaranteed values and he put it in the loan amount available, because every company that we use has been paying like dividends for over 120 plus consecutive years. So the thing you hear me say all the time is the guaranteed value on the illustration. The thing that really means is it's guaranteed to never really be that number, right? It's going to be a number higher than that because the company is always going to pay a dividend. Now, the last thing I'll say, and then we'll move on, is I'm not a huge fan of the cash value line of credit personally. But does that mean it's not for Chris or other people? No, not at all. Because see, when we use a cash value line of credit, we have to go through an extra step, and we have to do it through a conventional bank, which is totally fine. But just remember, if you ever get in a financial situation or a bind, the conventional bank, they want to be paid back their loan interest. They don't care what kind of bind or jam you get into. The insurance company will never ask you to pay back the loan interest, the policy loan. They'll never ask you ever to pay it back, right? The conventional bank will do that. However, if you're working with an insurance company that is direct recognition, right? And I know if a person is on this for the first time, they're saying, what in the hell does direct recognition mean? Well, a lot of you guys that have been following us for a long time, you know what it means. Direct recognition means that it's an insurance company that is direct recognition, and so the dividends can be affected if a person has a policy loan. So non-direct recognition is what we deal with mainly. Not all, because we do have one direct recognition company we work with, and that's Penn Mutual as of now, right? One direct recognition company. Does that mean, does that mean Penn Mutual or a direct recognition company is bad? Absolutely not. Absolutely not. All you got to do is realize that your dividends can be affected by having a policy loan. So it's just an extra step. It's just one extra step when we're dealing with a direct recognition company. I take policy loans from the direct recognition company, and I don't use the cash value line of credit, but it's completely up to you. It's like if both of us walk down the cereal aisle, I'm going to pick the Fruit Loops and Chris is probably going to pick the Special K. It's all good, man. It's all cereal, right? We all like the same kind of cereal. We would just have one kind on the cereal aisle, and we wouldn't need to have it for or just to have it satisfy everybody else. But anyway, all the companies we work with, including the direct recognition companies, are great companies because they've been paying these dividends year after year after year consecutively. So I just wanted to kind of throw that up too, that Chris, that the numbers we're looking at are just the raw form of the illustration and not taking the banking into consideration at all.
Let's get to some of the questions. Cam and Stephen, I'll let you direct this, but I just want to hit this one on Cam because I want to make sure that we were clear. You know, I have 8 of these policies, these specially designed and engineered whole life policies, and that's makes up my banking system. And 8 is not all that I will ever have. I will keep adding more. But you know, when I mentioned that about how I have one checking account, all I'm talking about is, so with the line of credit, so I have a line of credit that uses all 8 policies cash value. My line of credit, what that does, it gives me access to the cash value in all 8 of those policies with just one account, okay? Because the line of credit is just one account that basically is collaterally assigned with all 8 of my policies. So therefore, I didn't have to take the money out of my policies. My money never actually leaves the policies. Whether I borrow from the insurance company or I borrow from the bank with the cash value line of credit, my money never left my policies, which meant my money never stopped earning interest and dividends, which means my money is able to operate in an uninterrupted compound interest environment. That's the magic here. It's just mathematics. But the cash value line of credit just gives me the ability to simplify all 8 policies into one. In other words, I write checks from one checking account, which accesses all 8 of those policies cash value in the form of collateral. The bank's just lending me the money, but it's collateralized by the cash value. So for Cam, he was saying, so does that mean you have taken out all the policies to put into one checking account? In other words, I think what he's saying, I had to take the cash value out of the policies to put it into a checking account. Absolutely not. My policies are just collateralizing a bank loan, and they're giving me access to 100%, not 93%, as Andrew showed in that thing that, yes, I'm upset that it was wrong, but that's my fault for not double checking it before the training. So all of that considered, my money sits nice and cozy in those policies, earning interest, while I have access to use 100% of that money in the form of a checking account, which is nothing more than just that line of credit the bank gave me. Hopefully that clears that up.
Hey, Chris, the key point in that you made, and I hope everybody got this, is really, okay, remember, whenever you take a policy loan, you are not borrowing your money. No. You're not taking your money out of the policy. You're simply putting your policy up for collateral, and you're taking a loan from the general fund of the insurance company. So what does that mean? That means all your money that is in the policy is continuing to compound and grow, even though you're using the money. Now, I don't know another vehicle on this planet that allows you to do this with these features and benefits. And if there's a better vehicle out there, let me know what it is, because I've been looking for 15 years. So a loan on the policy is simply a prepayment of the death benefit. You never even have to pay back the policy loan if you don't want to. It's not required. The insurance company never calls you up or knocks on your door or anyway, they never just like send you a letter and say, hey, Mr. Naugle, when are you paying back the policy loan? They don't care, because you are the policy owner. You are the owner of the contract, which means you have first right to that money. As long as you want that money, you get to use it for whatever it is you want to use it for. If you're not using it, if you're not using the money, the insurance company will take it and put it into other investment strategies, such as, okay, and those strategies that they do, most insurance companies do, at least the ones we work with, mutual companies, they're going to put roughly about 80% of those dollars into investment grade bonds. Another 7% will go into policy loans to their policy holders. Another 7% will go into home and commercial mortgages. And another 7% they have to have almost as cash in a very low interest growing environment, because when death occurs, they have to pay that death benefit out in a timely manner. So no matter where the insurance company has those funds out in their portfolio, you are number one in line. Even if you're not in line, you get a cut in line in front of everybody else, move everybody to the back, and they got to serve you first. They have to give you the cash value that's available first. So even if they have to cash in some assets or whatever it is they got to do, when you come a calling, they got to come and serve you and give you the loan. So absolutely, the key point here is that your money, even though you're using your money, all of that money is continuing to grow in that tax-free environment, and the government's completely out of your hair. So you're earning uninterrupted compound interest. And that kind of leads to a question that I saw Joseph Clark ask. He says, and again, guys, I don't usually read the questions. I just happened to see this one. I know Stephen and Chris read the questions, but Joseph Clark says, what are the tax implications of your earnings? Great question, Joseph. The answer is you're not paying tax on that policy growth. And why is that? Because whenever you pay premium into the policy, Joseph, you've already paid tax on that money. because when you pay premium, you're paying it with after-tax dollars. So what you're doing is you're getting your money, okay, after you pay the tax, because that's what we want to do. Pay tax on our money one time only at the lowest rate possible. And we want to get that money into a tax-free, tax growth environment. And we want the government completely out of our hair. Now, as the policy grows, okay, that growth is tax-free. The growth is always going to be tax-free because we, if you're working with us in this strategy, the infinite banking concept, we are never going to take a withdrawal. Now, I hate to use the word never, but I almost want to use the word never, okay? But we're not going to take out a withdrawal. Big difference in the terminology. There's a loan and a withdrawal. What we're doing is we're taking out policy loans. Joseph, you have never been taxed on any loan. Have you ever been taxed on any money that you borrow? No. As a matter of fact, quite the opposite. You may even get a tax break or a tax deduction because you may have to pay loan interest, right? So yes, so that means that you could actually be able to deduct the loan interest. Now, I'm not telling you can. Get with your financial planner, your CPA, but let me just tell you this. Me personally, I deduct my loan interest anytime I use a policy loan for a business purpose. And I will tell you that every time I take out a policy loan, there is some kind of a business purpose attached to that, right? So I don't have to pay tax on that loan. And the growth continues to grow tax-free. And eventually, it's not an if, but it's a when. It's a definite. You are going to die, pass, graduate, whatever word you like to use the best, whatever word you like. I like to use the word graduate. You can use die, croak, pass, whatever it is. It's not an if, it's a when. At the time of your death, Joseph, what's going to happen is all of those policy loans that you have out of the policy, and you may have zero or you may have it maxed to the hill, those policy loans now are going to get paid off by the death benefit. The death benefit will pay off the policy loans. Let's just hypothetically say your death benefit's $1 million and you've taken out $400,000 in policy loans. Well, what happens is the death benefit doesn't go down. See, a lot of people think the death benefit goes down when you have a policy loan. No, 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 no. The death benefit does not go down. The death benefit is still the $1 million in this example, but they've already given you $400,000 while you're living. They've already given you that in advance, right? So basically an advancement of the death benefit. So they've given you the $400,000. So the $1 million will pay off the $400,000 policy loan, and your beneficiaries will get the additional $600,000 tax-free, plus all the assets the policy loan paid off. So that's why you don't want to take withdrawals. The only time I ever hear of somebody that talks about taking a withdrawal or they're considering it, if they have no family whatsoever, if they don't have anybody at all in their life, and if there's nobody they want to leave any money to, then maybe there's an argument for at a certain point to start taking out withdrawals. But that's like 0.0001% of the time. So a person that should take out a policy withdrawal is about the same number that a person is earning interest in a checking or savings account at a bank. It's a super, super low number, so low that you can't even hardly calculate it. It's like rubbing two pennies together. So I hope that kind of clears that up.
Yeah, let me just hit two things real quick, and then I want to bring Stephen in so we can hit some of the questions because they're coming in like wildfires. First one was, we get this question every time, which is the only reason I really want to hit this one head on. Nicole, I just see it's client, I believe. Do IUL policies fit into this concept? We get asked this a lot. IULs are the hottest product on the brokerage channel because they pay the highest commission. Simply put, you can do your own research and see that. But, I know a lot about these. Matter of fact, probably too much about IULs. And the simple answer is, Nicole, they do not work for what you're seeing. And once we get to the mapping process, you'll very clearly see why. IULs can be a good vehicle if you're planning solely for like a supplemental retirement, something that has a long-term time horizon, not for what we're talking about, where we're putting money into our banking system, which is using specially designed and engineered whole life, and then immediately, in some cases, taking that money back out, either as a loan from the insurance company, or as I showed you, using a cash value line of credit to leverage the cash value and using the bank's money. But we're taking that money out immediately, which means we need the access to the majority of the money, or a high percentage of that money early on. If you're talking about an IUL, not all, but most IULs, actually all IULs, have surrender periods, okay? Surrender fees in the early years. Sometimes it's 7 years, sometimes it's 11 years, depends on the contract. Those surrender fees cut into the amount of cash you have access to in the early years. There's always your accumulation value, and then there's the surrender value. The surrender value is usually very, very low in the early years, meaning if you're using an IUL to do the things that we're using this vehicle for, the whole life, then it would never work. The IUL should only, in my opinion, and also the gentleman, Bob Price, who I had on last week, and I did a nice call. The only reason I think IULs fit into any type of planning is as a supplemental retirement vehicle, where you're putting money in so that it's in a tax-free environment that will be used sometime in the later years. I would say beyond 10 years for sure. So I hope that answers that. And there was one more that came in, and we get this one a lot, so I'm gonna hit it really quick, Stephen, and I know you were answering it. Kojo came in and he said, what's the biggest difference between taking a loan from your policy and getting a margin loan from your brokerage account? So there's a lot more to this, but let me hit this one because we hear about this a lot. So if any of you have an account at Schwab or TD Ameritrade or one of the big brokerages, if you have enough money, usually it's a couple $1 million, depending on the brokerage, the number differs, you can get a margin loan account. So in other words, the brokerage will give you a margin account, giving you access to your portfolio value. Now, again, portfolio value, you're using the bank's money, and it's kind of similar to the cash value line of credit, where we're using the cash value to collateralize the loan with the cash value line of credit. What they do in the brokerage world is they use your stock or your investment portfolio to collateralize this margin loan that they give you. So what are the differences between the two of those? Because they are very similar. Well, number one, to get that margin loan, you have to have an account big enough where the brokerage will give you that money. And again, the variations, of how much it is, I've seen several million and maybe down to, I don't know, $500,000. So if you have less than that in a brokerage account, that isn't an option to you. And Kojo, correct me if I'm wrong on the dollar amounts that you know of. Secondarily, when you are using a margin loan, the first thing that you have to be very aware of and very concerned with is when you're dealing with investments by nature have risk. We're talking about a whole life policy, which is not an investment, which carries zero risk because it is guaranteed. So in our situation where we're using the cash value only goes one way, and that's up. Your brokerage account or your investment account can go up, down, sideways. It can go a lot of different ways. And if it goes down and you've got a margin account and you've used all the margin, there's a very good chance that they will call you up and say, hey, there's a call. They need that money back because now your portfolio doesn't collateralize the amount of loans. So that's some risk there. Secondarily, I don't know, the 93%, I knew that the numbers Andrew did were going to kind of screw it up. When you use a cash value line of credit against your policy's cash value, the bank will give you access to 100% of your cash value. The lowest I've seen it is 95, and that's if you got a low credit score, but we'll just call it 100%. So the 93% doesn't play a factor into what we were talking about with the cash value line of credit. With your brokerage account, they most likely will give you access to 100% of whatever your investment account is, and that will vary too. And the brokerage account, unless it's in a Roth IRA, more than likely is not tax-free. This environment where we're talking about the cash value whole life policy is all tax-free. It is guaranteed, carries zero risk. So those are your biggest differences, Kojo. I hope that helps. I know there's a lot more that you had in there, but that's your difference. Guaranteed, tax-free, and we only go one place, that's up. So there is no risk of ever getting a call or anything like that. A margin call is what they would call it. So Stephen, where should we go from there?
Hey, Chris, anyway, hang on real quick, just to kind of rewind back to that last little segment that you did on IUL. So anyway, I think this is where Chris and I disagree maybe a little bit. I don't think there's any reason for a person to have an IUL policy at all.
I'm just trying to be nice, Brent. I'm just trying to be nice.
No, I know, but I'm just saying that, right? So I know you said, hey, maybe long-term or whatever. I just disagree personally. It's not that I'm right or
Now,
wrong or
listen,
Chris is
Brent,
right or wrong.
I hate IULs.
Yeah.
There's a lot of
I
people
just
that
would
think that
never
they're the
buy
greatest
one,
thing.
and I would never own one, and I would never sell one, right? So I believe if you really understand the power of the infinite banking concept, that you would only want to do a whole life policy. Now, guys, you got to just kind of remember, I didn't come from the insurance background. This isn't what I grew up doing. As you guys know, I'm a chiropractor. I became a customer and a client of this back in I first heard it in 06. I started my first policy in 2008. I started teaching it in March of 2012. So it's been 10 years now, almost this coming March, that I've been teaching it. So I didn't get kind of like brainwashed or hoodwinked into all the other stuff that a lot of financial planners and advisors that have learned all that stuff. And then you had to kind of retrain your mind. So I came right into this, but let me just tell you, I will tell you that I personally have over 4,000 of my own clients in every state of the country over the last 10 years. Okay. And, I can tell you, and anyways, okay, the reason I tell you that is because I have talked to a lot of people in the last 10 years that have totally taken a bloodbath in their IULs, because the IULs are dependent on outside factors. What else is going on? What's going on in the market? And also there's always fees, charges, costs associated with that. So I've seen people that have put money into these IULs and it hasn't turned out the way that they thought it was going to. Now, if the stock market is rocking and rolling and it's doing really good, depending on where those dollars are, then you may be on the upswing. But however, it's not about what happens this year, next year. It's about the long term. This is not a sprint, it's a marathon. And any illustration that you look at on an IUL policy, and I've never seen one that doesn't have this, you look at the full illustration of an IUL policy and on the left-hand side is the guaranteed value. And that guaranteed value, the cash value and the death benefit, can go all the way down to zero. Not to mention surrender charges that are happening early in on the policy. I just talked to a client the other day. I mean, if he wants to surrender his IUL policy, he has been doing this policy now for, I don't know, a year. And he's put in $7,000, or actually he has $7,000 of cash value in his IUL. However, because he's only been doing it for 10 or 11 months, a little under a year, his surrender charges are $6,000. So he's got cash value of 7, but surrender charges are 6,000. Well, what the hell is that? 6,000 of the 7,000 is gone if he wants to get out of that thing. You know what I mean? So I just see that. I've talked to so many people over the years that have taken a bloodbath in their IUL. So if you truly want to do an IUL, here's my opinion. I'm not saying this is what you got to do, but my opinion is put money in a whole life policy and then borrow from the whole life to go buy the IUL, because the IUL is an investment. And the definition of an investment is it's something that can go up and it can go down. Whole life policy can never go down. So it's not an investment, is it? A lot of people think it is because it goes up, but no. A whole life policy can only go up. Today's better than yesterday. Tomorrow's better than today. The last thing I'll say on this, and I know Chris has done, I think Hannah has done some videos in the past. I might have even done some, I don't remember, on IUL versus whole life. So if you want to see videos of that, if you want to kind of peel back the onion more, okay, I'm going to throw Hannah on the spot here. Just send Hannah an email, HANNAH, Hannah@themoneymultiplier.com, and she can send you the resources that show our content, our educational content of where we're comparing whole life versus IUL. All right. Sorry, Chris, I went on a tangent.
That's all right. And it's something we've got lots of material. A brand new video is going to be put up soon where we show an IUL's contract and illustration from one of our clients. And then we show it just next to the whole life, not good, bad, or indifferent, just shows the true pros and cons. too many people are getting their information, you know, I don't want to say from the wrong source, but just remember, this is where it all comes down. You may think whole life pays a big commission, and regular whole life off the shelf does. It's about 55% of the premiums if you went to your broker or the life insurance store. The way we design these policies, because we design them backwards, we put the lowest death benefit, the highest amount into the paid up additions rider so that you have access to the most amount of money. We take a 60 to 90% cut in commissions so you have access to 60 to 90% more of your money immediately. That's how it works. So when you hear IULs are better, this, that, or the other thing, if you saw the trainings that your financial advisor got explaining IULs, they're definitely not painting the right picture. They are absolutely not. I've seen the trainings. I've seen how they actually compare the infinite banking concept to the IULs, and it's completely false. So all the brokers are not painted the right picture and not shown the right things because they're selling against whole life. Why would the brokers want, or why would the consultants and the training companies want their brokers to make 60 to 90% less? They don't, because that cuts into their pocket. They want them to sell the highest commission product. And guess what that is? The highest commission product is IUL. Facts, folks, facts. You want to know why you think whole lives or why IULs are better? You want to know why that's what you're hearing from your financial advisor, your bank broker, and everybody else? Follow the dollar, folks. Wake the F up. Like, that's what it is. Like, I don't know how else to put it. I don't know how to be nice about it. I don't like IULs. We don't sell IULs. I will never own an IUL. One person on our team owns it, and every day of his existence, he regrets that decision, but he did it, which is a blessing because now we get to actually explain it from inside. Anyway, moving on. I want to get back on topic here. I know we got a lot of questions. Stephen, should we hit some of these questions before we move on to mapping?
Yeah, I think so.
Let's do it, man.
We're here for the people. So, all right. So Mike was just saying, this is back to the CVLOCs, the cash value line of credit. Can you use a HELOC like a cash value line of credit, or do I misunderstand something?
Mike, if I'm understanding that question right, like kind of how I explained using a home equity or the cash value line of credit using your policies as collateral, could you do the same thing using your home equity line of credit? The answer is yes. And we've done trainings showing how to use a similar, you know, the infinite banking concept, the process, how to do that using a home equity line of credit. The problem is, if you do that with a home equity line of credit, you are not gaining the benefit of the uninterrupted compound interest. The whole life is the only vehicle that can pay you uninterrupted compound interest on a guaranteed basis on every penny of your money that you put in while still giving you access to it. Your home equity line of credit is great. It allows you to tap into the equity of your house. It allows you to use that, which you could do the same thing, lend it out, pay off credit cards, buy cars, but your money is not working for you. So you're missing a key element of why this concept that we teach works so well. And that is simply the mathematics behind compound interest. I mean, Albert Einstein spells it out. He says, compound interest, not even uninterrupted. He says, compound interest is the eighth wonder of the world. Those that understand it earn it. Those that don't pay it. You're not earning it when you're using just a home equity line of credit. But if that was your only option, it's not a bad one and you can do that. So hopefully I hit that question right.
Hey, Chris, one thing I want to add to that is, and again, so there may be some brand new people on the call, and a lot of people may not know that you and I wrote a book called Mapping Out the Millionaire Mystery. Mapping Out the Millionaire Mystery. And that question of the HELOC reminded me of it. Well, Chris and I talk about that in that book. It's on page 128. We talk about how to use a HELOC to fund the policy. So listen, all you got to do is just, okay, so like in order to get the e-version of this book, all you got to do is send one of us an email. Send it to me and I'll take on this responsibility. Send it to Brent, B-R-E-N-T, Brent@themoneymultiplier.com. Send me an email and I will email you the book that Chris and I wrote, Mapping Out the Millionaire Mystery. There's no cost. There's no sense in having the hard copy. I mean, if you really want the hard copy, we'll send you the hard copy. All you got to pay is for the postage. And I think it's like $2.80, but there's no need for you to get the hard copy. You can get the ebook. We'll send that to you in your inbox for free. And on page 128 of that book, Chris and I wrote, we talk about how to fund a policy with a home equity line of credit. So again, Brent, B-R-E-N-T, Brent@themoneymultiplier.com, and I'll send you guys out that ebook. Okay, go, Chris.
All right, I just got to read this. This is awesome. Steven, you want to read it or should I? Because this is amazing.
Yeah, I mean, they didn't share the comment with everybody, just to the hosts, but yeah, I mean,
just don't use their name. Don't use their name.
I'll type it. It says, I'm an assistant to a financial advisor, and I'm loving this answer about IULs because I've always felt off about them, especially when we get to annual reviews with clients.
Oh, wow. That is powerful.
Especially when we get to annual reviews where we actually have to show you the real numbers, not the numbers that we thought we were going to get for you. Holy
Well, I'll
shit,
just say
Merry
this.
Christmas.
I'll say this. Whoever that assistant was, we are always looking for new team members on the Money Multiplier team. So maybe you want to come and share the love with us, baby.
I love it. I had to, so we won't read the name. That was private, but that was impactful. Thank you for sending that. All right, what else we got, Steven?
All right, what's the pain in the ass factor about obtaining a CVLOC versus insurance loan?
Sure, easy. One page application. That's literally a 1-page application. 2-day approval process at the longest. And then the worst part about the cash value line of credit is you have to wait for the bank, you know, in my case, Coastal States Bank, to get the collateral assignments from the insurance company, which can take a week, maybe 2 weeks. Like some of my policies are with New York Life because that's who I used to be an advisor for, and they took forever. So that's the worst part about it. Outside of that, like there's really no bad part about it, except for, yes, we're trying to eliminate banks and just be the bank. And now we're bringing a bank back into the mix. But you know what? I can fire the bank anytime I want. So even though that might seem like a bad thing, well, why are we bringing a bank back into the mix? We're trying to get rid of banks because at any given time, I can call up the insurance company and I can say, Mr. Insurance Company, that bank pissed me off. Can you please send them a check to pay off that line of credit? And then you guys take the loans back on the books. And the insurance company will be glad to do it and say, yep, we were just waiting for this call, sir. We will get that check right out and pay off that stupid bank. So you never, ever have to use a bank again. And you can keep being your own bank. That's it.
Well, Chris, let me just add to that real fast too. And it's not a matter of, you know, always sticking with one strategy. It's what's working now. And right now we live in a 0 interest rate environment. So of course we're going to take advantage of the historically low rates. The banks are not going to offer that forever. That CVLOC might go to 7 or 8%, and while the insurance company stays at 5%. Yeah. So the insurance company interest rate, historically, that's happened in the past, right? So right now, though, in this world that we live in, let's take full advantage of the banks. We're not saying don't use banking, take full advantage of them. You real estate investors, you're going to keep leveraging your money using banks when it's appropriate. That's a strategy.
Yeah,
that's all.
Yeah, no, that's a good point, Stephen. And anyway, for all of you that have not read, or maybe you want to refresh or go back to Nelson Nash's book, Becoming Your Own Banker. Remember in the early 1980s where Nelson had money borrowed out, $500,000, and he was paying like 18 to 20% in interest on that money, right? Because that's what the prime rate was. And then he wasn't a prime customer, as he always says. So he had to pay a couple points above prime. But so the thing that he found out is that he could go to these insurance companies and borrow money at between 6 and 8%. And because he had funded all these whole life policies, actually more than one, and he didn't even really know the reason that he did it at the time. But he was like, man, I mean, all these dollars that I have inside of my policies, I can go borrow from them at 6 to 8% and totally eliminate my 20% loans that I owe to the bank. Absolutely. Now, I'll add one more point on that. You know, if Nelson Nash was alive today, even though we're in a low interest rate environment, he would still probably tell you, I would almost bet, that the thing you want to try to do is not do business with banks, because whenever you're doing business with banks, then you are just becoming part of the problem, or you're just adding to what, you know, they are able to do. So again, that's just Nelson's perspective of how I knew him and how he taught. But I will tell you, me personally, I will go all day long and borrow money from a conventional bank at 2, 3, 4%. And I will borrow their money and I will keep my money that I have the cash value in the policy and go use that money to invest in other opportunities, that give me 8, 10, 12, 15%, even more. I mean, Chris Naugle just turned me on to a deal about a month ago about how I'm earning 50% on an investment. You know, I mean, those don't come.
Wait, now my damn phone's gonna blow up. So that's not available
all right.
to
Well,
everybody.
anyway,
That was a
I'm
that was
sorry.
a
Maybe I
special thing
shouldn't
for
say
Brent.
that.
So sorry about that. That was definitely
All right, but that's totally outside of the box. But I will tell you that 10, 12, 15% is not uncommon. So I don't want. Okay, so anyway, I will give you an example of a home equity line. I don't want equity sitting in my house, because the equity in my house does me no good other than giving me the peace of mind knowing that it's paid for. Other than that, it's not doing me any good. Can I go down all day long to a bank and borrow money at 3, 4, 5% on the equity in my house? Absolutely, I can. Can I go put that into an investment or a real estate deal, or maybe go to Chris Naugle and Stephen Nagy at the Private Money Club and find an investment that will give me 8, 10, 12, 15%? Absolutely. So I want to keep the money in motion. The idea is to get all the money, as much money as you can, in the policy first. This is my opinion. And this is what Nelson Nash tells you too. Go look at the book, Becoming Your Own Banker, page number 48. 48, Nelson says, premium and income should equal. Every payment you make is a deposit in someone else's bank. You need to put that money into your bank first, because if you put it in a conventional bank, what do the bankers do with your money? They take that money, they lend it to you and other people, and they make a great living off of the money that you leave there. So you want to be the banker in your life. You want to control the banking function. So you want to keep that money in your family where you're earning the interest and the dividends instead of the stockholders and the shareholders of the conventional bank. So,
all right. So what we're going to do next is we're going to do a rapid fire, literally rapid fire, because we are quickly running out of time and we got to get to the mapping, because it's very important that you all see how our mapping team literally makes the money multiplier different than any other company that does what we do. It is our one differentiator, because we invested back in what this concept does for people and the problems we solve, instead of just, being the person that sells the whole life. Like a lot of our competitors, they want to sell the whole life because that's where they get paid. But then the answer to the people, that they're selling the whole life to is really, well, how do I use this? How does this money go to work for me? What can I do with this? Our mapping team solves that problem. It came at a huge expense for the money multiplier. We pay a big staff to be able to do this, and it costs you nothing if you're a client of the money multiplier. It's the one thing that differentiates us from the boys, if you will. But I want to get through some questions very quickly so that we can get into that, and I can let Brent show you the mapping system and how that actually literally can really change everything for you. Steven, let's get into these questions and do them really fast.
Yeah. So real quick, specially designed whole life. How is it specially designed? What is the difference between a regular one and one that's used for money multiplier? So the bottom line is cash value, availability immediately versus 10 years down the road. You want to add to that?
It's just how the plan is designed. We put the money into the general account of the insurance company through a rider versus putting all the money to the base part of the policy, which is where the cost of insurance is. So in other words, imagine a whole life where the death benefit is put at the lowest level and the amount of money that we're putting in goes directly to the cash value. That's what we're doing. It just turns the tides. But if the commission is based on the death benefit, what we're doing is we're putting the lowest death benefit, which means we get paid the lowest commission, and the rest of the money we're just putting into this PUA rider, which is what you have access to and what allows you to then earn early cash value and let that money go to work for you.
I'll just add one thing to that. All the whole life policies you've ever seen in existence before probably have zero cash value the first year, zero or very little the second year, and not much more the third year, because the policy is not designed just to give you that cash value. And the majority of agents don't like to sell you an infinite banking policy because they have to take a 60 to a 90% cut in their commission. And they're just not willing to do that.
I saw one the other day and it made me sick. It was, I think an IBC practitioner, a client brought it to me and said, hey, I had this policy design done. Can you tell me what you think? I looked at it and I'm like, I think this advisor is making a whole bunch of commission because they designed it for them, not for you. But you just got to be careful. You got to get somebody that knows how to design these and that isn't counting the commission, or just go with somebody that's not trying to sell this to you. We don't sell we do this. We will help you get started, but we never sell it. We don't have to. We just teach you and show you the ropes on how to make this work. What's the next
Well,
question,
actually,
Steven?
I just want to be clear what Chris just said so you guys understand. Chris said we're not selling you the policy, but if this is something you want to do, you want to come to us at the Money Multiplier because it's the only way we all get paid. Only one way only. You never write us a check for a dime. So the way we get paid is if you buy the policy from us, if you let us be your servicing agent. So we get paid a commission on the policy. It's just a 60 to 90% lower commission. I want to make sure I drive that home because a lot of you guys, what you do at the end of these, you call us up or send us an email or ask somebody and say, hey, I love that information that I heard on the Wealth Wednesday webinar. I'm going to go out and try to find me one of these policies. Who do I get it from? Here we are right here. You get the policy from us. Contact me, Chris, Steven, Gabby, anybody on our team. We are the ones that will design the policy for you. You don't pay us, you pay the insurance company. We get paid the same way your car insurance guy or gal gets paid. We get paid a commission on the policy that you start.
All right. You want to talk about the criteria that's determined for which company to use for an individual?
Criteria
I'll just say this. All the companies are great. You're probably going to have policies with all the companies we write with. I'm not married to any specific company. Don't chase dividends because one year a dividend may be higher with a company. The next year it may be lower. The criteria that we use sometimes comes into play on the health of the individual, sometimes the age and the state that they live in, because not all companies write in all states. But every single company that we use has been paying dividends for 100+ consecutive years. So if a person calls me up and say, hey, I really want this company instead of the other one, no problem. I don't care. As long as we write for them, we're good.
Well said.
Somebody that has no heirs wants to live off this money for retirement. Would they get penalized?
Not at all.
No. And if you have no heirs and you're looking for a beneficiary, my name is Brent Kessler.
My name's way
Kessler
easier to spell. It's Chris Naugle. Just put that on the beneficiary line and we're all good.
But for real though, that's part of the mapping we'll get into in a minute. We can map out retirement plans for you, use the policies to pay for themselves and drain them way down. Absolutely. Do it all the time. All right. Just starting my policy. If I put 3K in a month, I can use that 3K or do I have to wait until the end of the first year?
No, you can immediately use the cash value of the policy, whatever the cash value is at that time. But just keep in mind, all the policy illustrations with all the companies, they show end of year cash values, but you can start borrowing immediately. And my definition of immediately is within 30 days.
Yeah. And I will tell you my policy, I borrowed that money inside the first 15 days of my deposit.
All right. We talked about the margin call one. How does inflation affect the return on the policy if it does at all? You mentioned 4% guarantee, the idea being it always beats the inflation rate.
I'll answer this quickly and then Chris can add on to it. There is no better vehicle on this planet that I have seen to hedge against inflation because we're using it's not fractional reserve banking. See, a bank can lend out $8, $10, $12 for every dollar they have on hand. The insurance company cannot do that. They have to go by something we call Austrian economics. Now, I definitely suggest the more you want to learn, the thing you want to study is Austrian economics, where $1 has to protect $1. And I also want to talk about the guarantee. Don't get hung up in what the guarantee is. As you guys know, the guaranteed has went down, but the guarantee, yes, it's the lowest that the policy can ever perform, but our companies have been paying dividends 120+ consecutive years. So we have the guaranteed plus the dividends. And to be honest with you, and Chris and Steven can disagree if they want, but I believe the new products that have came out now because of the 7702 rule are even better than the old products because, and so here is a couple reasons why, because there's more cash value percentage to borrow now in the first year than the old products. And also the MEC limits have been increased, meaning if you want to stuff more money into a policy, we've increased the MEC limit. And the other thing is on some of the companies, the loan interest rate has actually decreased on the new product. So Chris, add to that.
Yeah, well, I mean, I just put it up on the screen. I just shared my screen. This video right here that we did, money in motion always beats inflation 100% of the time. If you are concerned about inflation, wondering, well, how can this plan, if it only pays me 3 or 4 or whatever percent guaranteed interest, beat inflation when inflation's over 6? Watch that video, because in your question comes a very important thing that you need to learn, because you simply don't understand this. And I would urge you to watch that video that I just put up there. It will explain how money in motion beats inflation 100%.
Hey, Chris, I want to add one thing that my daughter Hannah just mentioned. She also said the new product, actually the death benefit is lower, which is a good thing, because remember, we want to design the policy for higher cash, lower death benefit. Now, remember, the death benefit rises, the cash value rises, but because the death benefit is lower, that will allow you, as you're wanting to get like more and more policies or putting more and more premium into policies, it now will increase your insurability, meaning you can own more of these cash value policies. So that is a good thing. A lot of people may think of it as a negative, but it's actually a positive.
Absolutely.
All right. Is there a limit on how much you can fund a policy with, and how many policies can you open at one time?
The answer is there's no limit to how many policies you can have, and the amount of money that you can fund a policy with. It's not what you're funding it with, but it's basically your insurability and what is the death benefit the insurance company will allow. In other words, how much is your life value worth? Because you can't overinsure a body the same way you can't overinsure a car or a house. And the way the insurance company looks at you is what they're going to do is they're going to look at your age, your health, your gross income, and your net worth. So when you're answering the insurance questions applying for a policy, you want to make yourself look as big as possible. Don't lie, but make yourself look as big. See, a lot of people make themselves look little because they think it's the tax man asking the questions. No, this is the insurance company asking the questions. So make yourself look big. See, if the tax man asks you about how much you make and what your net worth is, we always tell the tax man that we owe everybody. We don't own anything, right? And we try to make ourselves look as little as possible. But the insurance company, make yourself look as big, because I promise you, the insurance company will not come to your house to count your pots and pans to figure out what your net worth is.
True. All right. Anybody that's licensed agent, how could someone become a licensed agent to do these types of policies?
The only way to become a licensed agent, at least with us, is to be banking yourself. You can't sell or teach somebody something that you're not already doing yourself. But if you are already a client and you are already banking yourself using the infinite banking concept, set up a call and we'll talk to you about how you could join us and be a money mentor with us and teach people and show people how this can change their life.
Yeah, we don't actively recruit or promote that, just so you guys know. Like, there's some companies out there that might have we want people that are doing this part of their lives that's built in. And if you want to share it with other people and make a small commission by doing so, then absolutely, we'd love to have you. All right, what if I took money out of the HELOC to use in the policy?
You mean if you took money, if you used your HELOC to fund your policy? I mean, we have a chapter in the book that shows that it can, or it can really work well, but there's some additional things you need to understand. So check the book out and read that chapter in there. I just don't want to spend too much time on that.
Yeah. Can a current term life insurance policy be used, or perhaps a 401k to fund the policy?
Term insurance is just life insurance. It's pure protection only for a term of time. So there is no value. So you can't really use a term policy to do anything. In your 401k, you can take a loan out up to $50,000. But again, it comes down to a mathematical equation. We got to see, does it make sense to take the loan, put the money through the policy? And the answer to that is always, what are we going to use the money for next? You have to have a place where that money can earn you more than what you have to pay back to the 401k and their biweekly payments or your paycheck payments.
Home equity lines of credit loans seem to be based on income. How about those of us who are self-employed and don't have regular incomes? How do you get the absolute max loan from your house in that case?
Kojo, it can be tough with home equity lines of credit because banks have a little square box. If you don't fit in it, you're SOL. But you could use a company like Quantum RE that will give you equity, the equity in your house without any loans and any payments by sharing in the upside appreciation in the future of the house. So there are solutions, there are ways to do it. It's just, again, for another day, it's too long of a topic, but we do have a YouTube video that talks all about those home equity lines of credit, or actually they're called home equity loan agreements.
And also there could be private lenders that will loan you money and take second position. I mean, I've done the, well, yeah, the thing is, I'm not going to take a second position ever, but the thing I've done in the past where people wanted to pull equity out of their house, I pay off their first mortgage and I take first position. So I'm in first position, I eliminate the bank. So there are private lenders that could do that too, but just know you're going to pay much more, like a higher interest rate than you would get from a HELOC at a bank if you go to a private lender, most likely.
All right. What's the max age for somebody for an insured on these policies?
Well, until
73.
about, yeah, well, until about 3 or 4 weeks ago, I would have said 73, but Hannah just told me we got someone approved at age 78. So I would have always answered 72, 73, wow. But now, but I guess I was lying because she just got a 78-year-old approved in the last month or two.
Yeah, as long as they're healthy, I mean, we can definitely give it a shot. And then somebody else did ask, what happens if a person cannot be insured? And we can talk about using somebody else's life. You can still own the policy, control it, use it for infinite banking. It would just be on the other person's life.
Yep, that's all you do is you just have a policy on someone else that you have a vested interest in. And probably the most common people for this are a spouse, a child, a grandchild, a niece, a nephew. It could even be a brother, sister, a parent, or it could be somebody that you have an interest in your business, like a business associate. It's just that you have to have some kind of vested interest in that business. I mean, think about what conventional banks do. Conventional banks take out policies on their key employees. All right, go back to 10, 12, 15 years ago. So at Walmart was taking out insurance policies on all of their employees without them knowing it. They can still do it. They just have to know about it now. So there are a lot of different options when it comes to that.
All right. All right. We're looking good. I think we should get into mapping. We got about 10 minutes.
Yeah, we have to. We'll come back to all the rest of the questions. I definitely, if you don't mind, when we come back, I want to hit Juanita's question.
I'm going to type them in too.
Yeah.
Well, also, Chris, can I just add too, for the people on the call, every Wednesday at 4:30 Eastern time, that's what this segment is for. Every Wednesday at 4:30 Eastern time, Chris and the team, they do what we call Ask Me Anything. It's kind of like the happy hour where people rapid fire questions, and it usually goes on for anywhere from a half an hour to an hour. So like if you're not already following Ask Me Anything at 4:30 Eastern time every Wednesday, you should be watching that.
Absolutely. And right before we get into this, and Brent, I'm going to let you do this. We've got this slide just to show like the baseline for how to get all the money back for the cars, but the mapping team did this, and then we've got the whole rest of them. But a little just commercial update, folks, a little interruption is we've got a 3-day event that we're doing, and it's coming up in January. All of you need to do that because this 3-day event is going to be epic. Some of the things we've got going on with this, you absolutely need to be at that. So Steven's going to put the link up for that as we go. You guys should check it out. It is not expensive, $197 plus you get a whole bunch of stuff, but you need to be there. We send you recordings. The second thing is more because of the times, and this is the time to give. So I don't know if any of you know, but there was a big typhoon that hit the Philippines, and somebody that we care about deeply, somebody that helps us at the Money Multiplier, was part of that ravishing typhoon, and it devastated our house. Now we put together a GoFundMe, and often I will just tell people about this because everybody wants to give, but none of you know this person, but many of you have probably been touched by this person if you're part of the Money Multiplier. I'm not going to give a name, but here's the thing. One of the laws of wealth is you have to give unconditionally. So I am going to tell all of you that you have to do something. I'm not going to ask you. I'm going to tell you you have to do something. We're going to put up a GoFundMe link. I want you to copy this GoFundMe link. And what I want all of you to do, and listen, call me an asshole, call me whatever you want. I'm telling you, you have to do this. Dig in your pocket and give $10. $10, that's it. If you want to give more, feel free. We have to help this person. Why? Because it's the right thing to do. And if this is the only time of the year that you give, great. You're tapping into the law. Shauna just the other day gave a check. She didn't tell me how much it was. She didn't tell anybody. She donated to this GoFundMe page for this person that helps all of us. And immediately after she did that, I gave her her Christmas bonus. The Christmas bonus was for the exact amount she wrote the check to this GoFundMe page to help this person. You see, none of you, I think all of you understand, but none of you truly understand how the universe works. When you give, you get. When you give unconditionally with no expectation of anything back, you get. We're going to put the GoFundMe page up. I usually don't ask for anything out of any of you. This is just a free training where we teach you. I am right now asking you, telling you that you have to help because it is the right thing to do. So dig in your pocket, dig in your heart, dig in your soul, and give $10. That's it. Okay. And you will change somebody's life and their family's life during a very needed time this holiday season. So Brent, sorry, I didn't mean to do that commercial break, but it's essential. So please continue on. We're going to talk about mapping and what we do at the Money Multiplier that makes us different than everyone else. And what really, really solves your money problems is this right here.
Okay. Yep. Thanks, Chris, for that. And so let me just ask you, on this screen that you have up, you say the Money Multiplier map, but this is actually the car example. It might just be titled wrong. Now, I'm okay doing either one. I can do
Brent,
the car example or the map.
So I put this up. I just put this up just to show people that because of the mapping, what we can do is we can actually show you into the future how this policy will solve your problem. And this is just the car example where the mapping team can show you how you'd get all the money back for every car you ever buy, drive, and own. But there you go. We'll go right into it. Okay.
All right. So anyway, on the mapping, now, again, I'm not going to go through all the map, the whole entire map, because again, all right, this is on our presentation, what we call the 90-minute. And if you haven't seen the 90-minute presentation, then I guess send me an email, Brent@themoneymultiplier.com, and I'll get that information to you. So I'm assuming most everybody on this call has already seen the full presentation where I walk through this map in great detail. But all I wanted to do was really kind of give you the high level of what's going on the map, just because a couple questions that I've gotten over the last couple weeks. And so I just wanted to clear up a couple things. So if you take a look at the left in the very first year, which is policy month 1, what this individual does is he puts in $25,000 into the policy in premium deposit. That's what he puts in to the policy, okay? Now, on this particular individual, he showed up to our door and he owed these 12 third-party debts that you see here up top. He owed these debts: Discover, Chase, American Express, Barclays, Lowe's, Nordstrom's, Wells Fargo, private loan, BMW, West Marine condo, and a house. And if you notice in each of those green boxes, it shows you how much he owed, what his monthly payment was, his interest rate, and the amount of time that he had left to pay on that loan, okay? And I see somebody writing $478,000 in debt. I thought it was like 470, but either or, 470, 478, either or. Okay, all right, let's call it 470. Good. So all those debts combined total 470. Now, this is how he showed up at the door, and he basically said, hey, man, help me get out of this mess that I'm in, okay? So the thing that our team does is like, all right, our mapping team, we design these maps for you. So I like to say that our work really begins once you put the policy in force, because we designed this map for you usually within 3 days, 72 business hours after you start the policy. Where a lot of people, when you go buy the policy, you buy the policy, pay the premium, and you never hear from them again. You never hear from the agent. We're the exact opposite, right? You're going to start the policy, and then we constantly service the policy, which means we're constantly updating this map. The thing we're going to do is update this map for you 2 to 3 times a year, every 4 to 6 months. And why are we doing that? Because wherever you're at today in your financial life is not where you were 1, 5, and 10 years ago, and it's not where you're going to be 1, 5, and 10 years from now. You're going to constantly go through your financial life, buy things, sell things, windfalls, downfalls, raises, demotions. It's constantly changing. All right, so high level here. Here's what he does. He puts in this $25,000, and he immediately borrows under loan available. He immediately borrows $14,300. All right, he takes that money, that $14,300, and he pays off Discover, Chase, American Express, Barclays, and he pays Lowe's down. Okay, so now, now again, the thing we're showing is approximately 60% of cash value here that he has available. So your policy could have a little more even, right? So the thing that he does is he just takes that money that he was paying Discover, Chase, American Express, and Barclays, which is 160 plus 200 plus 200 plus 228, which equals 788 a month, and he's just paying himself back that money. All right, because he was paying the creditors, but he no longer owes them because he's already paid it off. So he's paying that back to himself. So he continues to pay that money back for himself. Now, keep in mind, okay, the $25,000 is still in his policy, even though he's using 14 grand. So he's earning the uninterrupted compound interest on the 25 grand, okay, even though he's using 14. So he's using his money and it's earning interest as well. All right, so let's get to the end of the first year, beginning of the second year. And now he puts in another $25,000 in month 13. Well, now you notice he can borrow more than he could the first year. He has 14.8 that he can borrow. Well, now he takes the 14.8, plus he takes the money that he was paying himself back the previous 12 months, the money that's going into that miscellaneous account, which is a total in month 1 to 12, it's 9,400. So Chris, you'd have to go back to year 1 to show him the 9,400. If you can, maybe you can, it's okay, but it's all right. It's 9,400 plus, there you go. You see that down there, the bottom of the miscellaneous account where Chris is pointing to, 9,400. So we got now 9,400 plus the 14,000 and some change, which Chris will go to year 2 now. Chris will go to the second year where we just were on this. And now we're on year 2. So we got the 14 plus the 9, which is a total of 24,300, which is total funds available for use. So all we're doing is we're taking the money and we're going to pay off more debt. Now, it doesn't have to be debt. You could use this for expenses. You could use it for taxes. You could go on vacation with the money, do charitable giving. You could buy investment property. Whatever you want to use the money for is totally up to you. Some people say, well, I have no debt. All right, great. You have no debt, but you still have expenses, right? I know you like to put food in your belly, gas in your car, and you probably have to pay taxes wherever it is that you live, all right? Unless you're homeless and living under a bridge. But I think we're all into creature comfort, so let's just imagine that we all have to do those things. So now we're going to just continue to pay down the debt, okay? We're going to continue to pay down the debt. And now we get to the end of the second year, beginning of the third year, and now we put in the 25 again. Now, which is month number 25. Now, when we put in 25,000 in the 25th month, look how much we can borrow. We can borrow almost a little over 22,000. So can you see how those numbers are increasing? That now an IUL won't do that. You can't show me those numbers in an IUL policy. You can't guarantee it's going to go up, right? You can maybe hypothetically think it might, right? But I could hypothetically think that I'm going to get my picture on the Wheaties box or be, the next Olympic champion, right? So I guess we can think about whatever we want to think about, right? So now we're in the 25th month, which is the end of the second year, beginning of the third year. We put in 25, and now we can borrow a little 22, right? We can borrow a little over 22. Well, we take the 22 and we add the money that we were paying ourselves back because we're paying ourselves back. So we're playing honest banker. So we got 25.9 plus 22, all right, that we're paying ourselves back. So now we got a total funds in the 25th month of 48.3. Well, all we're doing in this case is we're paying debt. Now remember that we started with $470,000 that we owed to the third-party creditors. That's how we started. So up to this point, have I done anything stupid, ridiculous, or idiotic? No, ma'am. I'm paying off the debt. All I'm doing is I'm accelerating it. I'm not working harder, changing my cash flow, taking any additional risk, or losing control. I'm just adding one simple step in the process. All right? Now look what happens. We get to the end of the third year, beginning of the fourth year. Well, we put in 25 again because that's what we agreed to put in. Now, maybe you don't like the $25,000 number that we started with. Okay, take off a zero, put in $2,500 a year, put in $500 a month, whatever you want to do. You can choose the amount of premium you want to pay. You can pay it monthly, quarterly, twice a year, annually, and you can always lower the premium. So if the 25 grand's not a good number for you, then take off a zero. If it's too low of a number, then times it by 2 or add a zero to it. Whatever it is that you want to do, okay? So now look at the fourth year, the end of the third year, beginning of the fourth year, the 37th month, all right? So basically 3 years and 1 month. Now what do? Now we put in 25, and what can we use? More than we put in. Now, could you imagine if you had a business and you knew when you got to the end of the second year, beginning of the third year, the end of the third year, beginning of the fourth year, the 37th month of that business, that every dollar you put in the business was going to give you more money that you put in? If that was true, and if you could start a business from scratch and you knew that's exactly what would happen, how many of those businesses would you want to buy? How many would you want to own? Well, I hope as many as possible, right? And if it's not as many as possible, if you guys have a different answer, then you guys do not need financial counseling. You need severe psychiatric care, all right? So you want as many of these businesses getting in to the 37th month and beyond, right? And all it's going to do is increase from there. So let's go to the next year, the end of the fourth year, beginning of the fifth year, month number 49. Now what happens in month 49? Well, it continues to go up. We put in 25 and have 27 to use. So let me ask you this. How many times do you want me coming over to your house, and every time you give me $25, I give you 27? Do you ever want to stop that? Never, ever, 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 right? And you know, the longer we go, the more you give me, or every time you give me 25, I'm just going to give you more than 27. Because remember, the policy gets better, more efficient with time. It's not me telling you that. It's in your policy contract. Today's better than yesterday. Tomorrow's better than today. All right. We're almost done. We get to the end of the fifth year, beginning of the sixth year. All right. This is where we stop it. Now you put into that first policy, you drop it down from 25 to 10. Why do we drop it down that way? Because we're designing it. It's a specifically designed, specially engineered policy. Who was that, Joe, that asked the question before? I don't know if it was Joe or someone else, but it's not any ordinary whole life policy that you're going to get from your brother-in-law that sells life insurance. It's a specifically designed, specially engineered whole life policy that has high immediate cash value. And what is the definition of high immediate cash value? Within the first 30 days. So now we put in $10,000 into the policy in this example. How much can we use right away? Right away, $13,000. Now, I'm not a math genius or anything, but I know if I give someone 10 grand and they give me 13 grand, that is a 30% increase on my money. How much of your money do you want growing at 30% 61 months from now? You see, no matter what you're doing in your life right now, no matter what decisions that you decide to make, okay, time is going to pass. Eventually, 61 months is going to be here. It's coming. It's coming. The only way you won't see it is if you die before then. Pass, graduate, whatever word you want. And most of you on this call, most of you that are going to do these policies will not die, pass, or graduate 61 months from now. Because if the insurance company thought you were going to die in 61 months, die, pass, or graduate, they would never issue or sell you the policy. So the insurance company doesn't think you're going to pass, so you shouldn't either. So 61 months is going to pass one way or the other. The decisions that you make today are going to affect your life 1, 3, 5, 10, 20 years from now, all the way until you die, pass, or graduate. Now, if you wait 5 years to start, then you got to wait 61 months from the time that you start. So when's the best time to start the policy? Well, the best time was really yesterday, but we can't go back to yesterday and start it. So we got to start today, right? Go look at Nelson Nash. When's the best time to plant an acorn tree? It was 40 years ago, right? Right. So the best time is now because it only gets more efficient. But I want you to think of this as a business, right? How many businesses do you want to own that where in 61 months, you can, no matter what happens in the external world, in the external environment, it doesn't matter what the stock market does, the housing market does, pandemic, no pandemic, protest, riots, Republican, Democrat administration, it doesn't matter what is going on in the world. These are the numbers that are going to be happening, right? These are the numbers, the guaranteed numbers that are going to happen in your policy regardless of what goes on. So how many of these businesses, think of the policy as a business, because it is, it's a business, even though it doesn't have a brick and mortar building, even though it doesn't have, a bathroom and a toilet that's clogging up, it doesn't have employees that are bitching and whining and wanting vacation and wanting days off and calling in sick. No. This is a business that doesn't really even need your attention. If you give it a half an hour of your attention every 3 to 4 to 6 months, you're good to go, right? The business is going to run on its own. Well, how many businesses would you want to run on their own where you can put in 10 grand and have 13 grand to access? And I hope the answer is as many as you possibly can get. And now I didn't even go on to year 7, 8, 9, and 10. I will tell you my oldest policy is 13 years old. It turns 14 in February. And I will tell you in my policy, right, that's year 13, the 13th year, when I put in 10,000, that gave me almost 21,000 to use. That's right. I put in 10, it gave me almost 21. Well, what's going to happen in a couple months in February when I put in 10 again into that policy? It'll be a number higher than 21 because it can only go up. It can never decrease. All right. Now, in this example, what we did is we start a new policy. You see that brand new second policy? We start a brand new policy. And if you work with us, you're never going to wait more than 5 years to start a second policy. Most people start a policy before the first year is up. And let me define most people. I personally have over 4,000 clients in every state of the country. 91% of the clients that I've been working with that have been with me a year or longer have more than one policy. Of those, 70% come back before the first year is up, because they see how efficient this is and how effective that we work with them. Now, so what we did is when you go through the presentation, and I kind of fast forwarded it, what is going on here, but if you watch the whole map example, here's what we did. Remember how much debt this individual had. They had $470,000 of debt. Well, if you notice, they paid off all 12 of those creditors, all $470,000, and it didn't take him 218 months to do it, as it said in the beginning of the of the presentation. No, they paid it off in 61 months. 5 years and 1 month. So they did it in way less amount of time, and they did it with injecting $160,000 of outside money, all while keeping their cash flow the same. They didn't work any harder, take any additional risk, or lose control. How did I get to the 160? Well, how much? Because that's what they put in. Let's go back. Okay, Chris, it's all right. Stay on this screen. I'm just going to talk it through. How much should we put in year 1? 25. Year 2, 25. Year 3, 4, and 5, 25. 5 times 25 is 125. And then if you notice there in month 61, we put in another 10,000. So 125 and 10 is 135. And we started the brand new policy for 25. 25 plus 135 is 160. So we injected $160,000 of outside money, and we paid off $470,000 of third-party debt. Now, how cool is that, right? How would you like to do that? Is there anything stupid, ridiculous, or idiotic that we did? No, ma'am. All we did is started a stupid life insurance policy, and we're using it to pay the debt. You're going to have to pay the debt, the expense anyway. You're going to buy your cars, your products, and services anyway. All we did is added one step into our life. Now, the point I wanted to get to with this, and here's where some people, where I've gotten a couple calls the last couple weeks, and they say, Brent, on that mapping example, you never pay back the policy loan. You're right.
I'm glad you're going here. Thank
You're
God.
right. We don't pay back the policy loan, because why pay back the policy loan when you have use for the money? You see, all your money is in the policy compounding and growing, even though that you're using it. The only time I pay back my policy loan is if I have no use for the money. You see, all your wealth has to reside somewhere, okay? I'm Brent Kessler. I live in Florida. So I could either have my wealth reside in the conventional Bank of Florida, Wells Fargo, Bank of America, SunTrust, Chase, wherever you have your bank account, or I could have my money in my own bank, i.e. my policy, where I own and control it. I make the profits and the dividends, not the shareholders of the bank. I'm in complete control of the banking policy. I have first right to access that money. So would you rather your wealth reside in the conventional bank, right? The conventional Bank of Florida or whatever state you live in? Or do you want it in your own bank, i.e. the policy? Because listen up, ladies and gentlemen, boys and girls, here's the deal. The only difference between a conventional bank and an insurance company is the name on the door. That's it. It's just the name on the door. They're both depositories. They're both places to store your money. If you have a choice of where you want to store your money, do you want to store it in someone else's bank where they're making the profits and the dividends? Or do you want to store it in your own bank where you're in control and making the profits and the dividends? Now, let me add one thing to this, okay? Because I know there's still probably some haters out there. And as Chris's hat says, haters need hugs too. So let's give a hug here. So now, okay, I know a lot of you are all hung up on, well, what about the policy loan? Okay, let's say the policy loan is really bothering you. See, now I'm not going to pay back my policy loan. I'm going to take the money and I'm going to put it into other vehicles because I don't want money sitting in the policy. I want to use that money to make more money. But let's add up all the loans that we've taken out in the policy. And if I did my math right, I'm not going to have Chris add it up. You guys can get the spreadsheet and add it up on your own. But what we've done is we've taken out $132,000 in policy loans. That's what we've taken out, is $132,000 in policy loan. So the thing that we're done, though, is we freed up $5,777 a month. I'm just going off of Chris's number that he wrote at the bottom here. So now we have no creditors. We have no debts to pay, do we? I mean, okay, like in this example, we paid off all the creditors. So now what you would do is take the $5,777 a month that you were paying anyway. You were used to paying it, and now pay back the policy loan, the $5,777 a month, until you've paid off the policy loan. Now, I'm not going to do that. No, I'm not going to do it. I'm going to, instead of putting the $5,777 a month back into the policy, I'm going to go, maybe I'm going to use it for more products and services that I have to buy anyway. Maybe I have to buy more equipment for my business. Maybe I want to do a real estate investment, a real estate deal. Maybe I want to do a hard money loan. You know, whatever it is that I want to do, I want to keep the money moving. I want to keep the money in motion. So yes, you do a policy loan. Is the insurance company knocking on my door to pay back the policy loan? No, they never do, right? A policy loan is simply a prepayment of the death benefit. If you don't like the loan, then pay it off or pay it back, but you're in control. You're in total control of what you do with that policy loan. And if you don't pay the policy loan back, what happens? Well, eventually you die, pass, or graduate. So the death benefit will pay off that $132,000 loan. Because if you notice, I didn't even talk about the death benefit on this policy. How many hundreds of thousands of dollars or even millions of dollars is the death benefit? Yeah, the death benefit pays off the policy loan, and the additional money goes to your beneficiaries tax-free. And not only do they get that money, they also get all of the assets that these policy loans just paid off. And really, when you peel back the onion, all we did is added one simple step in our financial life. That's it. One step. Okay, Chris, anything I left out you want to cover?
Oh, I think you got it all right there. I sort of let you do your thing with this. I mean, this was just a different way of showing it. And, you know, every time, no matter what the person's needs and goals are, it's going to be the same. The mapping process is going to allow you almost to see the future and see what this system, this banking system, will do for you. If it's not debts, some of you are probably thinking, oh, I don't have any debts. Great. What do you want to do? You want to lend money? You want to invest in crypto? What do you want to do? We'll map it out for you, and we'll show you exactly what the system will do based on your needs and goals. And that, you know, a lot of people ask us, well, how do I know what policy design? How do I know what to do? Tell us what your needs are, and then we know the best design to solve that particular problem, and we do that work for you. We've tried making this so easy so that people don't have to think too hard about all the things that they don't know how to do, and they can focus on the things that are their superpowers, and then just use this system to, well, multiply their money and allow their money to work for them and be in their control. I think that's single-handedly the number one thing.
Yeah, Chris, and just to expand on that, guys, okay, remember, our mapping team does this for you. This is a service that we provide you. And not only do they design you the money multiplier map, there's also another form called the cash flow analysis. There's other tools too. I mean, look, there's tons of stuff, tons of different tools that we provide you. And if you want to get just a snapshot of those, go Google my name, go Google Chris Naugle's name, go put us in YouTube. Right? Put my name, Chris Naugle's name in YouTube. Go to our website, themoneymultiplier.com, and look at the 70 plus videos we just put up. Follow anything that Chris Naugle is doing, Facebook, Twitter, Instagram, whatever, TikTok. I don't know. Do you do Clubhouse? I don't know what all the stuff is that he does, you know? I mean, he's on about everything except match.com, but I mean, he's everywhere.
Yeah, the wife wouldn't like that.
Wife wouldn't like that. But just go follow the stuff. Get around the campfire and drink the Kool-Aid, man. Because the more you see this, and then like just continue to get around it. And then anyway, I want to do a quick plug. Just last week, what we did is we have our dates firmed up. May 5th, 6th, and 7th, we're doing a live mastermind event in Daytona Beach. In Daytona Beach, May 5, 6, and 7, Thursday, Friday, and Saturday. The event is 2 full days, Friday and Saturday. On the evening of May 5th, we're going to have a get-together. We're going to have a get-together at my house here right next to Daytona Beach in Port Orange, Florida. Last time we did it was in 2020, right before the pandemic, right? We did, was that right? Yeah, January of 2020. We didn't do one in 2021. I think we're limited to like 190 people. That's it. When we get to 190, we got to cap it out. So it's May 5th, 6th, and 7th. If you want more information on that, all you got to do is email. Probably the best thing to do is email either me, Brent at themoneymultiplier.com, or Hannah, Hannah, Hannah at themoneymultiplier.com. I think we're, again, I don't want to, please don't hold me to this. I think we're charging a couple $100 for the event, but we feed you, I think we feed you breakfast and lunch while we're here. We have, you know, the stuff we're doing Thursday night. And then I think we feed you breakfast and lunch on Friday and Saturday. Hannah just walked up. Is that right?
Yes, but I don't have links yet.
Oh, okay. But anyway, I guess the links aren't live yet. But if you think you want in, we got to stop it at, how many people do we got to stop it at? What's 200 is what she's saying. 200 people. So remember, guys, we have thousands of clients and we got to stop it at 200. So don't wait until April to book it, because once it's gone, because we've reserved the conference room. Okay, we got a special pricing on the hotel rooms at Daytona Beach Shores. It's called, what's the Hannah? Hey, Hannah, what is the hotel called? It's called the Shores Resort and Hotel in Daytona Beach Shores. So you can go check out the hotel and so the facility side. But anyway, we'll do my house Thursday night, and then Friday and Saturday it'll be balls to the wall information. And I'm going to tell you that like when you get together at a live event like this, it's not just getting together to learn the information. It's about the people that are going to be at the event. You guys are going to probably get way more out of the people that you're going to meet in between, like early morning in the breakfast or at lunchtime, or when you guys are doing evening dinner and things like that. So anyway, the event's not up yet, but it's coming. So just be looking out for that. It's only 5 months away. No, is it 5? January, February, March, April, May. It's 4.5 months away. It's just a little over 4 months away. So anyway, just keep that in mind. So, all right.
All right. So
Back to
Stephen, let's get to this one question. Juanita asked, will cash value still show 0 for the first 2 years? And with the cash, can we access the PUA part? I'm asking for clarity because I would not want that still showing 0 for the first 2 years, because like agents or a person who is designing the policy. So basically, we need to very simply put, if you buy yourself a regular whole life from your regular life insurance agent, or you buy it from the insurance store down the street, yes, your whole life will probably have $0 to use in the first 2 years, maybe even 3. We design them so that does not happen. We design them so you have access to your money immediately. How much money do you have access? Depends on which design and which problem we're solving for you, but between 60 and 90% immediately. And then you saw the rest of the numbers. That number just keeps going up and up and up and up, and it never stops, and it never looks back, and it never asks your permission to go up. So it doesn't matter what happens in the economy, the world, the markets, nothing. You only go one place, and that is up. So what you were asking, I think maybe you missed that part, but none of the policies, not one, will ever have 0 cash value immediately in the first 30 days. And if your whole life you look at from the person that designs it for you shows 0, you know one thing: they're having a hell of a commission. That's it. It's the big differentiator. Someone else has to give so that you get. Just like I told you all to donate $10. Somebody has to give so somebody else gets. It is the universal law. We give up our commission by the way we design this so that you alone have access to your cash value. It is the single most important thing. And it is why you probably cannot get this done with your regular advisor or your regular, agent. And by all means, have them run an illustration, and then take the illustration and send it over to us and say, hey, how does this look? I bet you 99.9%. I used to say 100%, but I said 99.9 because we had one New York Life agent actually get it right. Most of them will never, ever know how to design this because they were never taught in their industry how this works. Because how do I know that? 16 years as a financial advisor, not one time was I shown how this works. Not one time was I shown how to design a policy this way. And if you think I'm lying, then why in the hell hasn't your advisor called you and said, oh my God, you have to do this? Well, when you take a 60 to 90% cut in your pay, that will answer your question. And that's why you only hear about IULs.
Well, I also just real fast, I think Brent's about to say the same thing, but also even if your agent is able to design a policy like this that functions exactly the same and they give it to you, then what? Because I guarantee that agent doesn't know how to map it, doesn't know how to use infinite banking. I mean, the policy itself is just the vehicle. You got to know how to drive the freaking thing. And we don't, and all that mapping, everything we've been talking about today, we don't charge for any of it. You don't pay us a dime ever. Maybe $200 if you want to come get breakfast and lunch and hang out for a weekend at Brent's house. And that's it. Like, you'll never pay us any money. So it just makes sense.
Here's the other thing too. And I forgot to say this earlier, but this is what I'm going to end on. And then, Brent and Steven can say what they have to. When you're looking at what vehicle to store your wealth in, okay? And you're looking at it and you're saying, all right, there's IULs and there's whole lives and these specially designed whole lives. Which one do I do? I want to ask you, why do banks not offer cash value lines of credit on your IUL? Call up Coastal States Bank.
That's a good one.
Call up Russell and ask him, hey, say, Russell, I got this awesome IUL. The greatest thing since the toothpick was invented. Can you give me a cash value line of credit? I wish I had a sound machine that played crickets, because that's what you're going to hear. And Russell probably might just hang up on you because they don't issue cash value lines of credit on IULs because they know what they are. Just like
I didn't know that, Chris. Honest to God, I did not know that.
I just did a YouTube with Russell and I asked him that question. And the answer is no, we will not give you a cash value line of credit on that IUL policy that advisor sold you. Then I got to ask you, well, why the hell not if they're so good? Why don't you call Russell at Coastal States Bank or call M&M Bank or call Bank Corp or any other bank that does cash value lines of credit and ask the bank, why don't they like IULs? Why won't they give you money? But they'll sell them to you because they make the big old commissions, but they won't give you any money because they know they're dog shit. Sorry, I'm done.
That was powerful. I would really be curious. And so hopefully someone on this call will do the research and see if they can find any bank at all that will give you a cash value line of credit on an IUL policy. I never, ever thought about that. I'm stealing that and I'm going to use it in all my future IUL conversations. That was well worth the price of admission I paid to be on this call today.
Wow.
Absolutely.
See, that's awesome. Brent's the only one that paid to be here. Woo! Give it up for Brent. We're going to give that money right over to the GoFundMe. You know what? The last thing I'm going to say is the haters need hugs too. All right. If you like that video, make sure you check out this video right now. And also don't forget, subscribe to my channel and don't ever forget to smash that alert button. We'll see you on the next one.